All right, so here we are again. So we're actually partially through chapter 13. So before we carry on without any further, I have some cool videos for us to watch. So we'll start by taking a look at the classical gold standard and the quantity theory of money, which are again still part of the same period of history. And then we'll get back to our chapter 13 discussion. So, all right, well, first let's look at the classical gold standard. All right, let's hold on a second here. Whoops. Oh, crap. What did I do? Okay, I almost turned the whole thing off for a second there. Whoops. No, you're all still here. That's good. All right, so let's try that again. Oh, is it today? I guess it is. Yeah, because it was a week ago. Yes, tonight. Today's Thursday, isn't it? Yeah, I'm pretty sure we asked for it tonight. Yes, it would be midnight tonight. Okay, anyway, so let's get back to it. All right, let's check this out. All right, I guess we should all be just about done. So there's one more video we want to see right now before we get back into the notes, which is about something closely related to the gold standard, and that would be the quantity theory of money, which we started to briefly mention last time. So let's take a look at that now and see what that's all about. All right, let's look at this. All right, we should all be done by now. So anyway, so this next video is kind of a follow-up to what we just saw. It's about the quantity theory of money as well, but you're going to take it more specifically and look at how it explains how inflation is created in the economy and what effect it has on GDP growth and that type of thing. So Let me send this off to you. And let's check this out. Okay, well, we have another follow-up to the follow-up. So let's check this out. Again, it involves the quantity theory of money, which, for our purposes is really we're more interested in how it affects exchange rates and the current account deficit, but it's also very interesting to see it applied to other areas. So let's check this one out. All right. Well, you know what? Let's try this one too. It looks pretty interesting because it involves the financial markets. And again, in our chapter, this is really more about international trade, but this is still all directly relevant to what we've been doing. So let's check this one out too. Well, all right. I guess that'll do for now for those wonderful videos. Anyways, let's get back to 13. Let's just quickly review what we were doing. So we were looking at mechanisms of international adjustment. And so what we're trying to accomplish here in this chapter is to understand how the current account balance will adjust itself depending on other economic variables such as prices, interest rates, the competitiveness of the goods and services of that country, et cetera, et cetera. So there's many different theories that have been put forth throughout history about how the current account balance adjusts itself. Okay, so in other words, the idea is that if the current account is in surplus, that will lead to one set of adjustments that should, in principle, reduce that current account surplus until eventually it goes back to zero. And of course, if the opposite is true, if the current account balance is in deficit, there should be changes in the economy that create more of a surplus. In other words, they bring it back towards zero out of deficit. So quickly, just one more reminder, the current account balance itself only includes net exports, net income receipts, and net unilateral transfers. So primarily what they're referring to in these theories about the balance of payments is the net exports. Okay, net income receipts are driven by different variables. For example, let's say that Americans are buying foreign stocks and bonds, and as a result are receiving a significant amount of income from foreign countries. Most likely, this is driven by the relationship between interest rates in the two countries. And it's not so much about the trade deficit. And net unilateral transfers, those are basically one-way payments. For example, when the US government pays out foreign aid to other countries, that would be defined as a net unilateral transfer. Those are typically undertaken, again, for reasons other than changes in the trade balance. So what we're focusing really here on is how do surpluses and deficits with regard to our trade balance correct themselves if they do over time. So there's always been a lot of discussion about how this is supposed to happen. And there's a lot of different views as to how this takes place. And of course, not everybody agrees with each other about how these adjustments take place. So the theories that we are looking at here have been developed over several hundred years, going all the way back to the time of David Hume, who was writing around the same time as Adam Smith, around the time of the American Revolution, at a point in time when most countries had fixed exchange rates, and also many countries were on the gold standard. So circumstances were very different. And so naturally enough, the theories that were developed to explain what was happening would have been different as well from what we're seeing today. All right, so here we're going to start by assuming that exchange rates are fixed because this is more or less what was happening with most countries at the time that David Hume was writing. So we've already reviewed quickly what floating and fixed exchange rates are all about. A floating exchange rate or flexible exchange rate simply means that its value is determined by supply and demand in the marketplace. Although central banks may periodically jump in and take steps to keep their currencies from getting too strong or too weak. Technically, what we need to do here, let me just sneak this in here for a second. If you want to be super technical about this, a pure float means that the central bank and government of a country, well, let's just put this down to the central bank. The central bank of a country never intervenes in foreign exchange markets so that the exchange rate is entirely determined by supply and demand. Okay, so in other words, the markets take care of that. A managed float hold on. A managed float means the central bank of a country occasionally intervenes in the foreign exchange markets. Even then, though, it's usually only in response to large fluctuations in the country's currency. In other words, they don't normally do this unless it is becoming a problem. For example, just as a quick example here, in the early 90s, the Mexican peso basically depreciated very, very quickly due to falling oil prices. Now, Mexico is actually a major oil producer. And so if oil prices go down enough, that is a real problem for the Mexican economy. And everybody knows that. So if oil prices are dropping, people are likely to start selling their holdings of pesos, and that puts extra pressure downward on the peso. So in order to prevent a complete collapse of the peso, the Fed, or the Federal Reserve System, Central Bank of the United States, joined in an intervention with the Bank of Mexico to prop up the value of the peso. So it's only because the peso was falling so quickly, the Mexican government was worried that the economy was in danger of collapsing if this kept happening. Because while this is happening, interest rates in Mexico are rising very quickly, and prices are probably rising quickly as well. So this means that they want to avoid a complete disaster. So they got in touch with the Fed and said, listen, can you jump in with us and go out in the market and buy pesos and sell dollars in order to strengthen the peso? So the Fed joined in on that, and it did stop the peso from completely collapsing. I mean, it was still weaker, but it did accomplish the objective of keeping the peso from collapsing. But that happens very infrequently. It's very unusual that something like this happens. So technically, what we have with the dollar is a managed float, because the Fed may be willing to jump in once in a while, but it doesn't happen very often. A pure float simply means that exchange rates are allowed to float wherever they will go, depending on market forces. We didn't see a whole lot of this in the 18th century. Most countries were using fixed exchange rates, which were tied to their holdings of gold and silver. And so that's one of the reasons why current account deficits and surpluses usually corrected themselves fairly quickly. That's not the kind of thing you see today. In other words, if you look at the dollar and our current account deficits, you know that we have just one year after another with current account deficits, not small ones either, very large ones. And you would think then that the dollar would depreciate as a result of this, but it doesn't seem to happen. It's almost like the economy can absorb all of this debt, which is what it really is, and yet not affect the dollar. So the writers at this time would have been very surprised to see what's happening today with our string of current account deficits, and yet with the dollar remaining strong. They would have predicted that that couldn't happen. But again, we're not on fixed exchange rates, and we're also not using the gold standard. So a fixed exchange rate system or regime means that the central bank is keeping it at a particular rate. They do this on purpose because the feeling is that this is better than having floating exchange rates, but it means that they have to be constantly tinkering with the domestic money supply so that interest rates adjust in order to keep the currency at the level that they want it to stay at. So if the domestic currency starts to strengthen, then what the central bank has to do is reduce interest rates so that the currency starts to weaken again, because investors will pull their money out of this country once the currency starts to weaken. And of course, if the opposite happens, if the currency starts weakening, then this central bank has to reduce the money supply, which raises interest rates and basically stops the currency from depreciating any further. So the idea here is that in the short run, at least, high interest rates tend to make a currency very strong, and low interest rates tend to make it very weak. So this is why we were saying before with Mexico, as the Mexican peso started collapsing, their interest rates were rising, and that, of course, was putting further downward pressure on the economy, which made things even worse. And so, therefore, they had to call up the Fed and say, "Listen, could you please help us out here? We need an intervention that stops the peso from collapsing." All right, now we've already discussed the case of Hong Kong. They have a fixed exchange rate at 7.8 Hong Kong dollars per US dollar. They've had it for quite a while now. And the idea here is that they want to make it clear to every investor out there, every potential business person who wants to do business in Hong Kong, that one thing you don't have to worry about is foreign exchange risk with the Hong Kong dollar. In other words, the Hong Kong dollar is going to stay fixed to the US dollar at a certain rate, no matter what happens in the economy. You can count on it. And so they expend a lot of effort keeping this from falling apart. They spend as much time as they can keeping the Hong Kong dollar tied to the US dollar at 7.8 to 1, because it's important that people take them seriously, that they really believe that this exchange rate will stay fixed for the foreseeable future at 7.8 to 1. So anyway, so the good things about a fixed exchange rate regime are it provides stability to the nation's currency, it can help reduce interest rates, and it can help reduce inflationary pressures. In other words, when you have a fixed exchange rate, your interest rates and inflation rates will typically end up being very close to the US rates. And in many cases, that's exactly what they're hoping for. So small countries that have too much inflation or very high interest rates might be attracted to this option because it can help reduce their interest rates and inflation rates much closer to US levels. But there's the rub. You do not have control over your own monetary policy anymore, because your monetary policy has to be dedicated to keeping the exchange rate fixed. You can't then independently turn around and then raise or lower rates because of the state of your economy. So that's what you're losing, some independence. All right, anyway, so a current account surplus or deficit may lead to changes in domestic prices. Typically, a surplus will cause higher domestic prices because there's a stronger demand for your products without a change in the supply. And so what will happen is when domestic prices start to rise, all of a sudden our exports become very expensive and our imports become cheaper. And before you know it, we find that the current account surplus is shrinking and eventually it should disappear. Okay, that's how a price adjustment would work. A deficit would do the opposite. A deficit would tend to reduce domestic prices, which stimulates our exports, reduces our imports, and before you know it, theoretically at least, the current account deficit should disappear. Now, is that happening today with the US? No, absolutely not. So the theories here, like I said, were based on a time when most countries had fixed exchange rates. When they're not fixed like that, then we might have other results. And of course, we mentioned that David Hume wrote a great deal about this. He was basically criticizing this philosophy of mercantilism, where countries saw trade as being just another way of carrying out warfare. And they would try very hard to encourage exports to other countries, but discourage imports from those countries, to make sure that they always had a steady inflow of gold from other countries, which they would then presumably use to build up stronger militaries, which they could then use to acquire more colonies. Okay, so now remember, this is the period when a lot of colonization took place, when a lot of North America was settled, and South America too. And there was also a lot going on in Asia. The Dutch and the British in particular were constantly fighting over the islands in what was then called the Spice Islands, because spices were incredibly expensive at that time. And so whoever controlled the spice trade could make themselves very, very wealthy. So this is a time when all the countries are all looking at to take advantage of each other and make themselves as rich as possible. So, and then we talked about the gold standard, where money is gold, gold is money. And so the more gold you have, the larger is your money supply. And so if gold flows into the country, your money supply will go up and your interest rates will go down. If gold goes out of your country, the money supply goes down and interest rates go up. Okay, so anyway, and then here's our friend, the quantity theory of money, which we now understand very well. The only thing is in the book, they use Q instead of Y. That's the only difference between here and what you saw in the video. All right, and so the quantity theory of money shows that the nominal money supply multiplied by the velocity of money equals the price level times real GDP. And so, as they mentioned in the video, V and Q are typically assumed to be relatively constant. So therefore, any change in M will lead to a proportional change in P. So for example, if the money supply goes up 10%, then we would expect that prices would go up about 10%. So, but again, this is all based on the theories of the classical economists who are writing at a time of fixed exchange rates and the gold standard. All right, now we also mentioned that under the gold standard, assuming that the quantity theory of money holds, if the current account has a surplus or a deficit, gold inflows and outflows would automatically correct that surplus or deficit. How would that work? All right, so if we have a deficit, now remember, the way this works in those days, if you had a deficit, that means when you owed money to other countries, they could insist that you pay them in gold. That doesn't happen now, does it? Not at all. No gold flows back and forth between countries. So if there's a deficit, the worst thing that can happen is we have to pay interest to that country that we have a deficit with. Here, though, they could insist that you pay them in gold. So if that happened, we're starting to pay gold to foreign countries. Gold is flowing out of the country. The money supply is falling, and interest rates start to go up. Okay, prices fall, exports are stimulated, imports are discouraged, and suddenly, before you know it, there's no longer a deficit. So this is happening automatically through the flows of gold, or at least that's how it was supposed to work. Countries that have a surplus, well, for them, the domestic country could require that other countries pay them with gold. So that meant the gold would flow into the country, the money supply would go up, but unfortunately, prices would go up as well. And that would discourage our exports, stimulate our imports, and all of a sudden, before you knew it, the surplus would disappear. So this was an automatic mechanism for adjustment to a current account surplus or deficit. It all came down to flows of gold. All right, now, in addition to that, though, there was also, in the classical economist theories, room for the following idea that in addition to changes in prices due to gold flows, there could also be differences in interest rates that could also lead to changes in or adjustments to the current account balance. Not the current account balance, the financial account balance. All right, so in other words, the classicals are saying that the current account will probably change due to changes in prices, which are triggered by gold flows. But the financial account is a little different because remember what this consists of. We have U.S. assets held abroad, net of financial derivatives. We have foreign-owned assets held in the U.S., again, net of financial derivatives. And then finally, we have net financial derivatives. So what kinds of assets are included in this list? We have stocks, we have bonds, we have real estate, we have bank deposits. And so the bottom line here is that the flows in and out of the country of stocks and bonds are largely determined by differences in interest rates. Okay, interest rates. So if one country has different interest rates than other countries, then we would expect to see flows of funds into and out of these countries, and they would affect the financial account balance. All right, so we have a graph for this. Of course we do. Let me just show it to you real fast so you can get a sense of what's going on here. So we have on the vertical axis, what they've done in the book, by the way, they have combined the financial and capital accounts because the capital account is so small that they're sort of lumping them all together here. So this is the balance on the vertical axis. Above this horizontal line is a surplus, below it is a deficit. So according to, and this horizontal axis is not the US rate itself, but the difference between the US rate of interest and the rest of the world. So in other words, if this is positive, in fact, let me add this here. On the right-hand side here, US rates are greater than the rest of the world, let's say. On this side of the fence, so to speak, US rates are lower than the rest of the world. And so this, on this right-hand side, we have a positive differential. Meaning that our rates are higher. And over here, we have what we call a negative differential. So basically, the logic behind this graph is that the higher our US rates relative to the rest of the world, the more people will want to buy US financial assets, and vice versa. They might be more inclined to buy US stocks and US bonds, and to keep their money in US bank accounts, or buy US real estate for that matter. So that graph is based on the assumption. In fact, let me add a separate slide for this. The financial account balance will depend on the level of interest rates in the US and in foreign countries. Okay, so the way that works is this. For example, if US banks, just to keep it simple, we'll talk about bank accounts. If US banks pay depositors a rate of 3% per year, and foreign banks, and this means all of them, pay depositors only 2% per year, this will cause some investors, at least, to shift their funds from foreign banks into US banks in order to take advantage of higher US rates. And now we're going to assume that the same thing holds for other financial assets as well. Like, for example, this also means that US stocks and bonds and other assets are providing relatively higher returns than foreign financial assets. So that this attracts investment into the US and strengthens the US financial account. That's if our rates are higher. All right, now obviously if our rates are lower, then the opposite will take place. All right, so we'll just mention that. If US rates are lower than in other countries, this will make investing in the US relatively less attractive than investing in foreign countries. As a result, some investors will shift their funds out of dollars and into the foreign currencies, which will worsen the US financial account. right? So that will have a major impact on the US financial account. Now, having said all of that, if there's a change in interest rates, I guess what I should say here is in relative interest rates, this will change the relative attractiveness of the dollar and foreign currencies to investors. That's going to change something. In other words, all of a sudden, interest rates change, maybe in the US, maybe in foreign countries, and all of a sudden that changes the relative attractiveness of investing in the US and in the rest of the world. For example, if US rates suddenly rise, then the attractiveness, or I guess I could just call it the returns to investing in the US, will increase relative to foreign countries, so that investors, some investors at least, will shift their funds into dollars. This will strengthen the US financial account balance. So the Fed raises rates, and all of a sudden, investors are moving their funds into American assets. And before you know it, our financial account balance will improve. But of course, if the opposite happens, if US rates fall, then the returns, of course, do the opposite. To investing in the US will decrease relative to foreign countries, so that some investors, not maybe all of them, but some investors will shift their funds out of dollars and into the foreign currencies. This will weaken the US financial account balance. So basically what we're seeing here is that unlike the current account balance, which is largely driven by prices, here we're seeing that the financial account balance and the capital account balance with it are largely driven by interest rates, because it primarily consists of investments. That's the main reason. The current account balance depends on trade in goods and services, among other things. So their prices are what really matters to potential buyers of these products that we make. Whereas here, what investors are really hoping to do is earn the highest possible rate of return by deciding whether to keep their money in dollars or in foreign currencies. All of this activity will make itself felt in the US financial accounts balance. All right, so then let's get back to this graph again. So why exactly does it look like this? Now, the book calls this curve the CFA curve. I don't think they ever quite explain why it's called CFA, but what it's showing is that it's facing up because if we move to the right, what's happening is that the US differential, or the interest rate differential, is increasing in favor of the US. So a movement to the right means US assets are becoming more attractive. And as you can see, our financial or capital account surplus is growing. All right, so in fact, why don't I draw this on a separate graph, because it's getting very cluttered here, just so you can see what's going on. So we've got the US rate differential, meaning the US rate minus foreign rates, which is called the US differential. And over here we have the US financial. and capital account balance. And let's say the curve goes right to the origin. It doesn't have to, but let's say it does. And so remember, again, up here represents a surplus in this balance, and down here represents a deficit. On this axis, this represents US rates are higher than foreign rates. And on the left-hand side, it's the other way around, of course. US rates are lower than foreign rates. So you can see the curve is moving in a positive, it has a positive slope because the higher US rates go, as US rates rise, the surplus grows. All right, obviously, if we move in the opposite direction, if we go in this direction, US rates fall. Therefore, the deficit grows. And it's hard to do all of this without it getting cluttered, but the idea here is that if we move into the upper right-hand corner, US rates are rising and our financial account surplus is growing. If we go towards the left-hand corner, then the opposite is happening. There is a smaller US rate than in foreign countries, and as a result, our current financial account balance starts to move more into deficit. And the axes, by the way, right here, this is zero. Along the horizontal axis, our financial account is in balance, meaning it's not a surplus and it's not a deficit. Now, if you noticed on this graph, though, there's two curves. There's CFA 0 and 1. What's going on with that? Let's find out. How can there be two? All right, let's see. All right, so and then here we have U.S. rate, we call it the U.S. rate differential, but remember, it's just the U.S. rate minus the foreign rate. So if we had one here, we know why it's upward sloping. What has to happen to move this curve up or down for that matter? This means that some factor other than the US rate differential has changed. Any outside factor will work, but the idea here is that for the curve to shift up, US investments have somehow become, no matter what the rate of interest is, US investments have become relatively more attractive. At all levels of interest rates. In other words, there's something going on that's causing people to want to buy more more US assets than they did previously, even at the same levels of interest. So what could cause something like that? Why would suddenly it become even more attractive to invest in the US? Okay, well, let's think of some of them. Let me label this right now. Oops, hold on. Okay, these are the things that could cause this curve to shift up. And again, remember, all the thing they have in common is that in each case, US investments have suddenly become relatively more attractive than they were before. So what kind of things would happen besides US interest rates, I mean? So how about this? What if there's an expected increase in the profitability of US investments? In other words, just imagine that the stock market is really booming. Regardless of the level of interest rates, that will cause foreigners to want to invest more in the US and less in foreign countries. So that will cause an increase in the purchase of US stocks and bonds, and therefore the entire curve will shift up, regardless of whether there's been a change in interest rates. So that's a big one, by the way. A lot of foreigners hold a very large percentage of our stocks because they're seen as an excellent investment compared to foreign stocks. So that's why a lot of foreigners own a lot of like Amazon stock and Apple stock because it's attractive to them as well as to us. If all of a sudden the US economy starts booming again and stocks are doing exceptionally well, you'd probably expect to see this curve shifting up, and then our financial account will continue to improve. Or how about tax policies? What if the US government suddenly declares that foreigners don't have to pay taxes on any of their profits? In fact, I'm not even sure how that works now. It's kind of a sticky situation with taxes and foreign countries. Countries usually have treaties with each other that regulate or determine how they collect taxes from each other. But let's just say that something changed, and now, as a foreigner, the tax treatment is more favorable. Once again, you're going to find yourself wanting to put more money in the US and not so much money in foreign countries. So that would cause the curve to shift up. Either of those and others as well. Anything in general that makes our investments more attractive will cause that curve to shift up, of course. But then, of course, we also have factors that shift it down. If it can go up, it can go down, as you know. So let's look at those examples. And of course, basically, it's just the reverse of what we just saw. All right, hold on. Let me make this a little smaller. So it shifts down if, let's say, the economy is in a recession, or for whatever reason, a lot of American corporations are just not doing particularly well. Well, what do you expect? People in foreign countries will start to buy more foreign stocks. And so the result of that is that our financial account balance should worsen. And that means the curve will shift down. And also, less favorable tax policies, anything that makes it harder to invest in the US, like regulations, for example. What if the government imposes regulations on foreign investors that makes it more expensive to invest here? Of course, that means the curve will have to shift down because it's less attractive to invest in the United States. So anyway, this curve can show us the relationship, again, between the financial account balance and interest rates, but it also has the ability to show us what happens if other factors change as well. So this part was exclusively focused on the financial account balance. Remember, what we were doing earlier was all about prices and the current account balance. Now, obviously, by the way, of course, a lot of this theory goes out the window now because we don't have the gold standard, and the quantity theory of money may or may not actually hold in the short run. In fact, what they didn't mention in the videos, which I was surprised by, is that it's been determined from historical experience that the quantity theory of money tends to work the best for countries that have the highest rates of inflation. When you have low rates of inflation, the quantity theory of money doesn't work quite as well. The connection between money and inflation tends to be a little bit weaker. But anyway, it works to a certain point. And so, but this is all about prices and how the current account balance changes. Whereas this discussion here that we just had about financial flows and interest rate differentials is exclusively limited to the financial account balance. Now, on top of all that, later on in the United States, or actually in England, I should say, the economist John Maynard Keynes came along and said, guys, you're overlooking another important source of adjustments, and that would be incomes. Okay. Incomes is something that the classicals did not consider. So what Keynes basically is saying here is that if we have a balance of payments surplus, then people in the domestic country are becoming more affluent. And if they do that, if they become more affluent, they certainly will want to buy more of every product out there, including foreign goods. All right. So if you find yourself in your own country wanting to buy more foreign goods when there's no change in your exports, what that's going to do is that's going to reduce your current account surplus because you're importing more without exporting anymore. So Keynes said that part alone could partially account for the way the current account balance is adjusting itself. If we have more income because of our surplus, our imports will increase, our exports will not change, and as a result, the current account surplus will gradually shrink and theoretically should eventually go to zero. On the other hand, of course, the opposite can happen. If we have deficits, our income should drop as we export fewer goods to foreign countries. And naturally enough, that will reduce imports. And by reducing imports without any change in exports, our current account balance should improve until it rises to zero. Now, again, if you notice, this isn't really happening with the United States. We have deficits all the time. And yet, does that cause our deficit to shrink? No. If anything, it gets worse over time. In spite of the fact, you can see, according to Keynes, we should have a current account deficit equal to zero because income should fall as a result of our massive deficits, but it just doesn't seem to be working that way at this point in time. So the thing about economic theory, unlike physics, is that once you come up with a theory in physics, it works. That's it. Here, this is different. These theories might have been correct at the time that they were invented, but since economic circumstances are so different now, things that were written by Keynes in the 30s and David Hume in the 18th century may have been valid at the time, but not so much anymore. And that's one of the kind of the strange things about economics. After all, it is a social science, but unlike a hard science like physics or chemistry, once a rule has been determined, it just doesn't change. Like the speed of light doesn't change, for example. The laws of gravitation never change. The laws of motion, they always stay the same. Here, economic circumstances can change. So, like for example, now when we're not on the gold standard, the way the current account balance reacts could be very different than what it did during the gold standard. So anyway, that's pretty much it for 13. We're going to briefly look at 14 as well, I guess sometime next week. But once we're done with all that, we're going to take more of a big picture look at the history of exchange rate systems throughout the last, let's say, 200 or 300 years, and see what kinds of exchange rate systems have been tried and what are their advantages and what are their disadvantages. So that, I think, is exceptionally interesting. And it gives us an excuse to touch on things like the creation of the euro. What is that all about? How did that happen? That by itself could take up a whole semester. But it is an extremely interesting story. And we get to look at other historical exchange rate systems that have been tried and in many cases abandoned. But it's important to gain insights into what was happening with these systems to see in what ways they were strong and in what ways they were not so strong. So we'll do all of that, don't you worry. And then in the meantime, though, I guess it's getting pretty late, so maybe we should knock it off right about here. And then also don't forget about your exams, but I will see you all next Monday. All right, any last minute questions? Okay, good. Then I'll see you next time.
Have a great weekend.
All right, you too. All right, bye.